There is a silent wealth transfer happening right now, and if you do not understand it, you are on the wrong side of it. This is not some conspiracy theory or get-rich-quick scheme. This is a fundamental shift in how wealth is created and destroyed in our modern economy. And it is happening whether you are paying attention or not. Let me ask you something. Why is it that your parents could buy a home for 3 times their annual salary, while today that same home costs 10 times what you make in a year? Why could a single income support an entire family back then, but now 2 incomes barely cover the basics? The common answer you will hear is inflation, but that is just a word. It is a label we put on something much deeper, something most people never take the time to truly understand. What I am about to share with you is not taught in schools. It is not something your financial advisor will explain, because frankly, most of them do not understand it themselves. But once you see it, you cannot unsee it. And more importantly, once you understand it, you can position yourself on the right side of the most powerful force in economics. Here is the truth that changed everything for me. Money is not what you think it is. You have been conditioned your whole life to believe that a dollar is a dollar, that saving money is the responsible thing to do, that if you work hard and put away a little each month, you will be fine. But what if I told you that the very act of saving money in the traditional way is almost guaranteeing that you will fall behind? Think about it like this. Imagine you are on a treadmill, but someone keeps increasing the speed without telling you. You are running harder and harder just to stay in the same spot. That is what is happening to your purchasing power right now. Every single day, the money sitting in your bank account is quietly losing value, not because you are spending it, but because the system itself is designed that way. Now I know what you are thinking, but I am earning interest on my savings. Sure, you might be getting 1% or maybe 2% if you are lucky. But meanwhile, the real cost of living is going up by 5 or 6 or 7% every year. Healthcare costs are skyrocketing. Education costs are out of control. Housing has become unaffordable for an entire generation. Your interest is not keeping pace, and it never will. This is not an accident. This is by design. And the people who understand this design are the ones building real wealth, while everyone else is working harder just to maintain the same standard of living their parents had. Let me tell you about something that happened in the 1970s. There was a fundamental change in our monetary system that most people are completely unaware of. In 1971, the United States ended the gold standard. What that means is that before 1971, every dollar was backed by actual gold. There was a physical limit to how much money could be created. But after 1971, that constraint was removed. Money became what we call fiat currency. It became backed by nothing more than trust in the government. Now think about what that means. When money was tied to gold, there was discipline in the system. Governments could not just print unlimited amounts of currency. But once that link was broken, the floodgates opened. And over the past 50 years, we have seen an explosion in the money supply that would have been impossible under the old system. Here is where it gets interesting. When you create more and more money, but the amount of goods and services in the economy does not increase at the same rate, you get inflation. It is simple supply and demand. More dollars chasing the same amount of stuff means each dollar is worth less. But here is what the wealthy figured out a long time ago. If you are holding cash, you are a loser in this game. Cash is being devalued by design. But if you are holding assets that rise in value as more money enters the system, you win. Real estate, stocks, businesses, commodities. These are the things that benefit from monetary expansion. This is why the wealth gap keeps getting wider. It is not because rich people are greedier than they used to be. It is because they understand what money actually is and they position themselves accordingly. They own assets. The middle class owns cash and works for more cash, and every year that gap gets bigger. So what does this mean for you? It means you need to fundamentally rethink your relationship with money. Stop thinking of saving as putting cash in a bank account. Start thinking of saving as acquiring assets that will hold or grow their value over time. The people who figure this out early are the ones who build generational wealth. The people who do not figure it out spend their entire lives working hard and wondering why they can never get ahead. Now let me show you exactly how this plays out in the real world, because understanding the theory is one thing, but seeing it in action is what really drives the point home. Look at what happened during the pandemic. Governments around the world printed trillions of dollars. In the United States alone, they created more money in 2 years than in the previous 200 years combined. Think about that for a second. More money created in 24 months than in 2 centuries. And what happened? Did everyone get richer? No. The people who owned assets got significantly wealthier, while the people who depended on wages and savings got left behind. Stock markets hit all-time highs. Real estate prices exploded. Cryptocurrency went through the roof. But the average person working a regular job saw their buying power decrease, even if their salary stayed the same or even went up a little bit. This is the game. And once you understand the rules, you realize that financial education is not really about budgeting or cutting coupons or finding the best interest rate on a savings account. Those things are fine, but they are playing at the margins. Real financial education is about understanding how the monetary system works and positioning yourself to benefit from it rather than be a victim of it. Let me give you a practical example. Imagine 2 people, both earning $60,000 a year. Person A follows conventional wisdom. They save 10% of their income in a savings account. They are disciplined. They are responsible. They feel good about themselves because they are doing what they were told to do. Over 10 years, they save $60,000 plus, maybe a few thousand in interest. Person B thinks differently. They also save 10%, but instead of putting it in a bank account, they put it into assets. Maybe they buy a rental property with a small down payment and use leverage. Maybe they invest in index funds. Maybe they start a side business. Over that same 10-year period, the value of those assets grows not just from their contributions, but from the overall expansion of the money supply and the appreciation that comes with owning productive assets. Fast forward 10 years. Person A has their $60,000 sitting in the bank, but that $60,000 now buys what maybe $40,000 used to buy because of inflation. The person B owns assets that have potentially doubled or tripled in value. They have built real wealth, same income, same savings rate, completely different outcomes. This is not about being smarter or working harder. This is about understanding the difference between saving currency and saving value. Currency loses value over time by design. Assets that produce cash flow or appreciate, or both maintain and grow value over time. Now here is where people get confused. They say, but what about risk? Isn't it risky to invest? Isn't it safer to just keep money in the bank? And my answer is this: you need to reframe what risk actually means. The conventional definition of risk is the possibility of losing money. But there is another kind of risk that nobody talks about: the certainty of losing purchasing power. When you keep cash in a bank account, you have a 100% certainty that it will lose value over time. That is not risk. That is guaranteed loss. When you invest in quality assets, yes, there is volatility. Yes, there are ups and downs, But over long periods of time, productive assets have always outpaced inflation. Always. So the real question is not whether investing is risky. The real question is whether you can afford not to invest. Let me tell you something that most financial advisors will not say out loud. The traditional advice of saving money for retirement and living off the interest made sense when interest rates were high and inflation was low. But we do not live in that world anymore. Interest rates have been suppressed for years. Real interest rates, when you account for inflation, have been negative. That means you are paying for the privilege of lending your money to a bank. The system has changed, but the advice has not kept up. And this creates a massive opportunity for people who are willing to educate themselves and think differently. So what should you actually do? First, you need to shift your mindset from being a saver of money to being an acquirer of assets. This is not about gambling or speculation. This is about systematically building a portfolio of things that hold value: real estate, stocks in productive companies, commodities, skills that increase your earning power, businesses that generate cash flow. Second, you need to understand the power of leverage. Now, leverage gets a bad reputation because people abuse it. They borrow money to buy things that go down in value or to speculate wildly. But used intelligently, leverage is how wealth is built. When you buy a home with a mortgage, you are using leverage. You put down 20% and control an asset worth 5 times that amount. If that asset appreciates, you get the gains on the full value, not just your down payment. The wealthy understand this principle and use it across all kinds of investments. Third, you need to think in decades, not days. The reason most people fail at building wealth is not because they make bad investments. It is because they have no patience. They buy something, and when it does not go up immediately, they panic and sell. Or they see something go up, and they chase it at the top. Wealth building is boring. It is consistent. It is long-term. You acquire good assets, and you hold them through the cycles. Let me share something with you that took me years to fully grasp. The biggest mistake people make is not understanding the difference between income and wealth. Most people spend their entire lives optimizing for income. They chase promotions. They job hop for higher salaries. They work overtime. And there is nothing wrong with earning more money. But if all you do is convert your time into dollars and then spend those dollars, you will never build real wealth, no matter how high your income goes. I have seen people making $30,000 a year build more wealth than people making $300,000 a year. How is that possible? Because the person making $30,000 understood that every dollar they saved needed to go to work for them. They bought a small duplex and house hacked it. They invested in low-cost index funds consistently. They built skills that created additional income streams. Meanwhile, the person making $300,000 bought a bigger house in an expensive neighborhood, leased luxury cars, went on lavish vacations, and at the end of the year had nothing to show for it except a lifestyle they now have to maintain. This is the trap that catches so many high earners. They increase their income, but they increase their lifestyle at the same rate or even faster. They end up on what people call the hedonic treadmill. More money coming in, but also more money going out. No real wealth accumulation. Just a fancier version of living paycheck to paycheck. Wealth is not about how much you make. Wealth is about how much you keep and what you do with what you keep. It is about building assets that generate income independent of your time. This is the only way to achieve real financial freedom, because financial freedom is not about having $1 million in the bank. It is about having enough passive income from your assets to cover your lifestyle without having to work. Think about what that means. Right now, most people trade time for money. If they stop working, the money stops coming. That is not freedom. That is dependence. But when you build a portfolio of assets that throw off cash flow, whether that is rental income or dividends or business profits or royalties, you have broken that link. You can choose to work because you want to, not because you have to. Now let me address something important, because I know some of you are thinking this sounds great, but I do not have any money to invest. I am living paycheck to paycheck right now. How am I supposed to start buying assets when I can barely pay my bills? This is a real concern, and I am not going to pretend it is easy. But here is what I will say. The gap between where you are and where you want to be is not primarily about money. It is about knowledge and decisions. I have watched people start with nothing and build substantial wealth, and the common thread is always the same. They educated themselves. They made sacrifices, and they stayed disciplined over long periods of time. If you are living paycheck to paycheck right now, the first step is not investing. The first step is creating margin. You need to find a way to spend less than you earn, even if it is just $50 a month. That might mean cutting expenses. It might mean increasing income through a side hustle. It might mean both. But until you create that margin, you cannot start building. Once you have that margin, no matter how small, you start acquiring assets. Maybe you cannot buy real estate yet. Fine. Start with fractional shares of stocks. Start with learning a high-income skill that you can monetize. Start with buying tools or equipment that let you earn more money. The specific vehicle does not matter as much as the habit of converting your savings into things that grow in value. And here is something critical. Do not wait until you have it all figured out. Do not wait until you have $10,000 saved. Do not wait until the market crashes, or until you finish reading 5 more books, or until conditions are perfect. Waiting is the enemy of wealth building. Start small, but start now, because time is your greatest asset when it comes to compounding. Let me tell you about the power of time. If you invest $5,000 at age 25, and it grows at an average of 8% per year, by the time you are 65, that 5,000 has turned into over $100,000. You did nothing except wait. You did not add another dollar. Just that initial 5,000 growing over 40 years. But if you wait until you are 35 to invest that same 5,000, it only grows to about 50,000 by 65. You lost half the potential gain by waiting 10 years. And if you wait until 45, you only end up with about 25,000. Same amount invested, wildly different outcomes based purely on when you started. This is why I get frustrated when I see young people spending everything they earn. I understand the temptation. You want to enjoy life. You want to travel and go out and have experiences. And you should do those things, but not at the expense of your future self. The decisions you make in your 20s and 30s will determine the quality of your life in your 50s and 60s and beyond. You do not need to live like a monk. You do not need to deprive yourself of everything enjoyable. But you do need to be intentional. You do need to understand that every dollar you spend today is a dollar that cannot work for you tomorrow. And those dollars working for you over decades is what creates the life you actually want. Now let me bring this full circle. We started by talking about the silent wealth transfer that is happening. We talked about how the monetary system works and why holding cash is a losing game. We talked about the difference between income and wealth, and we talked about the power of time and compounding. But here is the most important thing I want you to take away from this. You are not powerless in this system. Yes, the game is rigged in favor of people who understand it. Yes, it is harder than it was for previous generations. Yes, there are structural challenges that make wealth building more difficult. But none of that means you cannot win. The people who win are the ones who stop making excuses, who stop blaming the system and start learning how to navigate it, who stop waiting for perfect conditions and start taking action with what they have right now, who understand that wealth building is not a sprint or even a marathon. It is a lifestyle. It is a series of small decisions made consistently over long periods of time. You have a choice to make. You can keep doing what you have always done and keep getting what you have always gotten. Or you can decide today that you are going to educate yourself, that you are going to think differently about money, that you are going to start building real wealth instead of just earning and spending. The information is out there. The opportunities exist. What is missing for most people is not access to resources. It is the decision to commit, the willingness to delay gratification, the discipline to stay the course when it would be easier to give up. I promise you this. If you take what you have learned here today and you act on it, your life will look completely different 5 years from now, 10 years from now, 20 years from now. You will look back and realize that this was the moment everything changed. Not because you discovered some secret, but because you finally understood how the game works and you decided to play it intelligently. The wealth transfer is happening. The only question is, which side are you going to be on? Now I want to get specific about something that is going to happen in the next few years. Something that most people are completely unprepared for. And if you understand this, you can position yourself to benefit enormously while others are left wondering what happened. We are entering a period of massive economic transition. The old models are breaking down. The assumptions that guided financial planning for the last 50 years are becoming obsolete. And the people who cling to those old models are going to get crushed while a new generation of wealth is created. Here is what I see coming. We have printed so much money over the past 15 years that there are only two possible outcomes. Either we get serious inflation that destroys the value of cash and fixed income investments, or we get a deflationary crash that wipes out debt and resets asset prices. Both scenarios are painful, but they create very different opportunities. In an inflationary environment, the winners are people who own hard assets and productive businesses. Real estate goes up. Commodities go up. Stocks of companies that can pass costs on to consumers go up. But bonds get destroyed. Cash gets destroyed. Anything with a fixed return gets destroyed. If you are sitting in treasury bonds or a money market fund waiting for safety, you are actually in the most dangerous position possible. In a deflationary environment, the winners are people who have liquidity and low debt. When asset prices crash, the people with cash can buy everything at a discount. Real estate becomes affordable again. Stocks go on sale, but the people who are over-leveraged lose everything. The people who bought at the top using maximum debt get wiped out. So which is it going to be? Honestly, I do not know. Nobody knows. The central banks are trying to thread the needle between these two extremes, and maybe they succeed for a while. But eventually, one way or the other, we are going to have a reckoning. There is too much debt in the system. Too much money has been created. Something has to give. But here is the beautiful thing. You do not need to predict which scenario happens. You just need to be prepared for both. And the way you do that is by building a balanced portfolio of assets that can weather either storm. You want some hard assets that protect against inflation. Real estate, precious metals, commodities, companies that own physical resources. You also want some liquidity. Some cash or cash equivalents that let you take advantage of opportunities when they arise. and you want to avoid being over-leveraged. Do not stretch yourself so thin that a downturn destroys you. This is what the truly wealthy do. They diversify not just across asset classes, but across scenarios. They are prepared for multiple possible futures. Meanwhile, the average person is making one big bet without even realizing it. They are betting that the system stays exactly as it is, that their job remains secure, that their savings keep their value, that everything just continues on the current path. And that is the riskiest bet of all. Let me give you another insight that changed my thinking. Most people approach investing backwards. They try to find the perfect investment, the one stock that is going to 10x, the one property that is going to make them rich, the one cryptocurrency that is going to moon. And they spend all their energy trying to pick winners. But that is not how wealth is actually built. Wealth is built through systems, through consistent processes repeated over long periods of time. The question is not what is the best investment. The question is what is the best system for acquiring and holding assets that matches your situation and your goals. For some people, that system is buying rental properties one at a time and building a real estate portfolio. For others, it is dollar cost averaging into index funds every single month regardless of market conditions. For others, it is building businesses that generate cash flow and then reinvesting that cash flow into more businesses. The specific system matters less than having a system and sticking to it. Because here is what happens when you have a system. You remove emotion from the equation. You do not panic when markets drop because your system says keep buying. You do not get greedy when markets soar because your system has rules about taking profits. You just execute the system and let time do its work. The biggest enemy of wealth building is not lack of money or lack of opportunity. It is lack of discipline. It is the inability to stick to a plan when your emotions are screaming at you to do something different. Fear and greed destroy more wealth than any market crash ever could. This is why I always come back to principles. If you understand the principles that govern how economies work and how wealth is created, you can adapt to any situation. You are not dependent on hot tips or market timing or getting lucky. You have a framework that works regardless of the environment. So let me leave you with the core principles that have guided my thinking and that I believe will serve you well no matter what happens in the years ahead. Principle 1. Understand that money is not wealth. Money is a tool for acquiring wealth, but it is not wealth itself. Wealth is assets that produce value. Focus on accumulating assets, not accumulating currency. Principle 2. Think in decades, not days. Short-term volatility is noise. Long-term trends are signal. Position yourself for where things are going, not where they are today. Principle 3. Diversify intelligently. Do not put all your eggs in one basket, but also do not diversify so much that nothing you own can really move the needle. Find the balance between risk and concentration. Principle 4. Use leverage wisely. Leverage amplifies returns, but it also amplifies risk. Only use leverage on assets that generate cash flow and never so much that a downturn wipes you out. Principle 5. Invest in yourself. Your knowledge and your skills are the most valuable assets you will ever own. They cannot be taxed or inflated away or confiscated. The more you know and the more you can do, the more opportunities you will see and the better decisions you will make. Principle 6. Stay humble. The moment you think you have it all figured out is the moment you are about to get taught a very expensive lesson. Markets are humbling. Economies are complex. Always be learning. Always be adapting. And finally, Principle 7. Take action. Knowledge without action is worthless. You can watch every video and read every book and follow every guru, But if you never actually do anything, you will never build wealth. Start small if you need to, but start. Make mistakes, learn from them, adjust and keep going. The world is changing faster than ever. Technology is disrupting entire industries. Artificial intelligence is going to transform the job market. Demographics are shifting. The geopolitical landscape is unstable. And the financial system is under more stress than most people realize. All of that sounds scary. And it is if you are unprepared. But it is also the greatest opportunity of our lifetime if you know how to navigate it. Because periods of transition are when the most wealth is created and when the most wealth is transferred from those who do not understand what is happening to those who do. You now have the knowledge. You understand how the game works. You know what to focus on. The only thing left is the decision. Are you going to act on what you have learned, or are you going to go back to your old habits and hope for the best? I hope you choose action. I hope you choose to build real wealth. I hope 5 years from now, you look back on this moment as the turning point. The day you stopped being a passenger and became the driver of your financial future. Thank you for watching. Now go make it happen.